Welcome, everybody, to another episode of Asset Backed, the podcast focused on specialty finance and fintech lending, among other topics. Today, my guest is a friend and also a general partner in an early stage venture fund, Luke Timberlake. Welcome to Asset Backed.
Thanks for having me.
On our show, Luke, we are always trying to cultivate relationships and bring on guests that are on the front lines of the specialty finance, the fintech lending, and related areas. Credit has grown so much. But you guys come at it from a slightly different angle with Fintech Ventures, and I'd love to hear more about that. But before we jump in to your firm, tell us your backstory.
Great. So I started off right out of college doing on-campus recruiting, and this was during the financial crisis, not to date myself, but I ended up at Merrill Lynch, which had merged with Bank of America. So I had two different logins, my Merrill login, my B of A login. And I was doing project finance and infrastructure investment banking, primarily debt capital markets and advisory work for municipalities across the northeastern United States. And we were looking at everything from privatization of toll roads to debt to run the buses and subways through the MTA, and even did some interesting tax exempt structures where we did one of the first commercial mortgage-backed securities that was tax exempt for several office buildings in New York City. So I got my start there, cut my teeth for 3 years at Merrill Lynch. And as a result of that, actually one of our former clients was doing infrastructure, private equity, looking at buying real estate and other sorts of assets from municipalities. And I ended up going over there to work on parking company acquisitions. And we looked at acquiring parking companies from municipalities and then putting in operating companies to run them. And a lot of what I was doing there was not only raising the equity as a fundless sponsor, but actually going after project finance debt as well. And one of the ways that we financed these parking companies that we ended up buying was using more traditional project finance structures, because the leases for the parking companies, especially in Manhattan, had similar profiles to other sorts of real estate and infrastructure assets that you could get project financing from over 30 years with, at the time, 4 to 5% interest rates. So as opposed to going out and raise mezz financing, although we did some of that, we financed a lot of the transactions using project finance, even those more operating company types of assets. That's actually what brought me down to Atlanta, where we had several companies that I was working with, and met my current partner on the fund, who I ended up stepping back from the private equity world to join. Took about 6 months off, and we launched Fintech Ventures in 2016. And our thesis, which comes from my partner's background founding a small community bank in Atlanta, was that at the time, there are certain areas of finance where banks and other large financial institutions cannot step in to serve for a variety of reasons. Fixed costs are too high for these banks to service them. Regulatory reasons prevent them, or they're simply just not interesting areas because the loan sizes, et cetera, are too small to move the needle. And this is the core focus of our fund. To get to the thesis, we're investing primarily in non-bank lending and private credit focused companies, whether that's the originators themselves, whether that's technology around the space, or whether it's companies that have some sort of use case within the private credit and alternative lending verticals. So I'll pause there. That's me in a nutshell.
Well, you sound like you come at venture capital with a somewhat of a different background than some of the VC folks that I've met. A lot of times they have been an analyst and maybe then worked their way up at a VC shop or a couple of different VC shops. You come at this with a real credit skill set and a real fixed asset infrastructure, real asset background. The first question that comes to mind is when you made that transition in in this first move into venture. Like, how did you do that successfully? Because that background and that training, I would imagine, has served you well, given the credit lens, the underwriting lens through which Fintech Ventures is looking to invest. But initially, you're now focusing on the equity of these companies and like how big they can get. So maybe could you talk about that transition?
Sure. So the way I like to describe what we do, which again may be different than other venture capital firms, is that we take a private equity approach to early stage investing in alternative lending and private credit focused originators. So, what that means is that even before these companies have originated their first loan, we're looking at the unit economics of what we think they could be. And we're also thinking about helping them raise credit if we don't provide it ourselves, which I'll get to originate these loans from day one. And that, in my view, separates us from a lot of other venture capital firms that might be looking at lending businesses from terms that you probably heard, like ARR, ACV, CAC,
Right.
that still factors in. But you can't really underwrite lending businesses, even if they're, have a technology angle or raising venture capital, in the same lens as you would a software company. So we take a credit underwriting approach. We're still trying to, generate venture backed returns, but we take a credit approach to every company that we look at. And that leads to us kind of passing on a lot of companies because we're looking from fundamentals from day one when there is no real data behind these companies to go off of.
Yeah.
And, fortunately, because of the industries they operate in, a lot of the unit economics for these businesses can be somewhat estimated going forward because in most states you can't have a consumer loan that's over 36% for certain sizes and durations, so you kind of know what the upper end of what the company can charge if they're originating consumer loans to prime consumers, for instance. Or if you look at the cost of capital, it's somewhat fixed because it's a competitive market and you kind of know what people are going to borrow, or I should say companies will borrow in order to lend out money to consumers. And then similarly, you have a general idea what the customer acquisition costs will be at scale by looking at some of their publicly traded competitors. And the age-old adage that I give in fintech is, especially for lending, if someone's if someone has not tried your idea, it's the chances are it probably hasn't worked at this point for a variety of reasons because you can't make money doing it. So in my view, there are no new lending products. There's only real new customer experience changes and maybe shifts in certain business models that have occurred and been the status quo. But it's very difficult to just go out and do new products given the regulations and kind of the competitive nature of financial services.
Yeah, I mean, it's such a gigantic and quite fluid market that ideas get replicated, or it might not be true innovation. If what I'm hearing you say is it's a version of X that's applied perhaps to a new uh, part of the economy. Quite interesting. So at Fintech Ventures, you mentioned your team, your partner came from having launched a community bank. We have a lot of banks in the US, and banks are not historically known for their innovation. We know that in the banking ecosystem, we have our gigantic, sort of too big to fail banks. That's not the vast majority, though. in terms of number. The vast majority of the banks are smaller banks, local community banks. Can you talk a little bit about why fintech in general over the last, call it 10 years, it feels has continued to capture market share from banks as it relates to lending and some of the more specialized lending businesses? Because, like you said, making a loan and doing lending has been around for a long time. Um, are these fintechs able to do it quicker, better, more profitably because they don't have branches? Like, I just would love to hear, like, what's the banking setup and how's that affording opportunity for innovation?
It's an interesting question, and I would say it's also evolved in the last 8, 9 years since we started. So, as I mentioned, we started investing in non-bank lending companies that are filling gaps that community banks or larger financial institutions can't fill for a variety of reasons. So, an example of that is doing lending for someone to buy a home, fix it, and flip it. You can't go to a bank typically for that because it's a non conforming mortgage. Or a small business loan under 250,000, typically for a bank, it's not really worth the time to underwrite that loan. And so people are willing to go out to financial technology companies or even companies that are deemed to be specialty finance companies with low or no tech still originating these loans on spreadsheets, which is another area of opportunity for fintech. People are going to these types of lenders because it's easier for them to get a loan, even if they pay for that same loan, sometimes 30 to 50% more in terms of interest. They're willing to do that because banks have been deemed to move too slowly, or don't even have the ability to underwrite or service this customer that needs a small business loan of $250,000 or a bridge loan to buy and flip a home for another $500,000. So that's kind of been one area that fintech has stepped in, and that's been really proliferated from the financial crisis in 2008 and some of the capital reserve requirements, without getting too much into it, that have made it difficult for banks to operate in some of these spaces that I just mentioned. But fast forward, and part of our evolving thesis, I would say, really, at least what we noticed in 2020, due to the pandemic, et cetera, a lot of community banks and credit unions, and we really think that community banks of around 250,000 to 2 billion, where there's several thousand of those are kind of sweet spots for fintechs to target. There, we've seen a fair amount of innovation and these banks and stakeholders embracing lending technology to help them modernize their operations to compete with fintechs. And that's really happened, since the pandemic, at least from what we've seen. And we started to look at companies there that are helping community banks and credit unions either buy loans that have been originated by a fintech or helping them originate products that they're able to do legally but didn't have the ability to do so because they lacked the technology or personnel to do. And so that's kind of what we've seen when it comes to the shift, let's call it, in the last 5 years within the community banking space as it relates to lending.
Yeah, one of the guests that I had on Asset Backed recently were a couple of founders from a consumer auto finance software startup called Karus, I believe, Karus. You can find the show on our Asset Backed website. But one of the things that they do is partner with banks, credit unions, and others that want to lend to underlying dealership groups, for example. And they provide an AI-powered, AI-driven underwriting, credit decisioning that doesn't replace the existing underwriting; it sits on top of it, and so you get sort of the force multiplier, pardon me, on top of the data that they already have, being the originator. And so I think that that's an interesting dynamic that you see within fintech. They're not all lending businesses, but they do, like you said, power lending. When you look at fintechs through this lens of what Fintech Ventures finds most interesting, are you looking for SaaS businesses as well as originators, or could it be one or the other, just depending on a variety of different factors?
So I would say that's also evolved over time, but in my view, the greatest area of improvement within fintech or financial services as it relates to lending, I should say, comes down to improvements in customer service. It's not innovations in the products, as I mentioned, although you will see new products out there, but the learning curve for these new products can be quite steep. And, one example I give to people is that, home equity lines have been around forever, but, within the last 10 years, fintechs have introduced home equity investments where you don't pay interest, but you get someone to buy a portion of your home. But at least from what we've seen, having looked at 20 plus of these platforms, is that the customer education component of that is never factored into the CAC or friction. And it's actually quite difficult to explain a new financial product to someone without people on the phone or boots on the ground or something that's, just not incrementally scalable. So that's kind of one thing that I like to point out, is that for us, fintech is innovation in the customer service, maybe the back end processing, but it's not necessarily in the new products, at least from what we've seen. So we're looking for industries right now that are actually what people could call niche industries, that are not as large as your average, let's say, prime consumer lending, which can be trillions of dollars in outstanding receivables, but are actually smaller and have been overlooked because they're not exciting enough. And I'll give an example of a company, for instance, that we think is interesting and invested in, that fits this. The company is doing floor plan finance for used auto and power sports and agricultural dealers. And they're offering this financing because still you're calling up the auction as a used car dealer and as a used car, at a used car dealership, and you still have to clear the financing via the phone. And there have been no web innovations because a lot of fintech entrepreneurs have overlooked it because it's just not an exciting enough
Yeah.
space for some. But it's a pretty large market, about 40 billion. There's 2 to 3 players. One is publicly traded, somewhat fragmented, has all the components in place. And the innovations in technology that you can make seem small for the rest of us that are used to these, but are quite large and can create high customer attention pretty quickly because they're, such game changers for the operators of the business themselves. So to give you an example of that, it's simply linking your bank accounts, because you have several different ones that you use to fund the purchase of used autos, into one tab that shows you in real time every single inflow and outflow of cash. So you don't have to open 6 different windows to check your bank accounts manually and see when the money is hitting to clear, so you can go out and buy new autos or tractors, you name it. And those little improvements are actually quite game changing too. But to 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 go even further and dive down into that example, this company has also developed a SaaS product that is separate from their lending business, that is focusing on financial institutions to give them the ability to issue inventory loans to their customers, because it is a pretty cumbersome process to have to look after the collateral and make sure all the covenants are hit and all the titles are cleared, etc. And so this is giving community banks and credit unions the ability to offer inventory financing to their customers. And so they have this, what I call a dual threat model. And that's what's most interesting to us, as well as kind of diversified lending products that have a SaaS business and a balance sheet business and are not over reliant on one or the other.
Yeah, one of the I guess the outsider's perspectives of venture as an asset class, and I'd love to ask you about the environment the last couple of years, is that it's such a long dated asset class, right? And that the fund lives are 10 to 12 years. And, the hit rate historically, I mean, if you look at the data, the top decile of venture firms, you know, vastly outperform the other 90%. Maybe you take the top 25%, and the PitchBook data says, that they generate, I think I saw this week, 25% on average annual returns. I think the top decile is even higher, 30+% annualized. But when you look at the bottom 50%, right, of VC firms, the numbers start to really diverge. My question is, with such a long dated asset class, how does a venture firm, when looking at fintech, um, again, the lending part of this has not innovated dramatically over the last, hundreds of years. Ways in which you service the customer, engage the customer, maybe even originate the customer have evolved dramatically with technology, and so with the backdrop of a fund life that's 10 to 12 years in a gigantic industry, how does your firm approach identifying innovation, and or if it's not innovation that you're looking for, management teams or ownership teams that have a competitive advantage to service the customer base differently or better? Like what are those characteristics that comprise, if it isn't innovation in the lending per se, but it's the service aspect or other features, like what are the hallmarks of those teams?
I would say the first thing is that even being within fintech, we've found it best to specialize. And so, even though we've invested in wealth tech and the companies are doing well, or in insurance, which we still like more and more over the last couple of years, we've continued to double down on our focus on alternative lending and private credit focused companies. And as a result, you start to build somewhat of a brand where you get sent a lot of the deals within the space, and you can kind of understand via pattern recognition, which is really the ultimate advantage that you have, what will work and what may not work. But, at the end of the day, the general rule of thumb is that, you'll do 10 deals, and, 2 to 3 of them will give you outside returns of 3 to, 5x plus. And then the rest may give you 0 to 1 times your money back. So even with perfect information, you're still not going to be correct after 10 years. And to your point, you probably don't know until 7 to 10 years into your investment whether it will go wrong or not. And I tell people that if you stack rank all of our companies from a certain point of time, it looks like a mangled spaghetti mess by the end of it, in terms of highs and lows, and being outperforming versus coming back. It really depends, and a lot of it too, whether it's in fintech or other industries, is dependent on luck and headwinds and tailwinds. So a lot of
Yeah.
it honestly comes down to that. And it's sticking to a thesis, but also having the ability to evolve that thesis as necessary. And for us, like I said, we were looking at companies that were competing or filling niches that community banks and credit unions couldn't serve. And now we've come full circle to investing in companies that are enabling these institutions to offer products to their customers that they couldn't normally offer, because the fixed costs of doing them manually without technology were too high. So a lot of it just comes back to having a thesis, but also being able to tinker and adjust on that thesis.
Yeah, I'd love to run a little bit deeper on the idea of founders and their preparing their firm, whether it's for an equity raise, and or if they're an originator and doing some type of specialized lending as a part of their business or their business, like the debt capital markets compared to the equity capital markets, there's just a lot less um, price discovery. There's a lot less information out there when it comes to the debt capital markets. But yet, you all, it sounds like, what if I heard you correctly, Luke, you all have seen enough of these models that you can kind of look at a business and see if they've baked in enough cost for educating customers and acquiring customers and serving customers as one variable. Question is, have the founders over the last few years that you're seeing their businesses and specialized lending and private credit related fintechs, have they gotten better at preparing the things like their loan tape and their models, their risk models, their origination strategies? Have they gotten better, or do we still see a lot of founders um, that are just coming to market like underprepared, not unprepared, but underprepared relative to what the stakes are?
Uh, it's an interesting question because I would say that up until the last couple years, there was a lot more debt capital out there at the earlier stage up for grabs, and models that work in a zero interest rate environment were getting funded, but currently are underwater or will not get funded. So I wouldn't necessarily opine on whether the founders are better or worse prepared. I think the answer I would give is they need to be better prepared, because just like the venture markets, the private credit markets, especially at the early stage, are much more competitive to get first tranches of financing. And a lot of it comes from, like I mentioned, being able to understand your business in the grand scheme of other peers at scale that may not be using tech or may not be similar, but you can kind of understand what the general cost of acquisition will be, default rates, etc., will be by looking at some of the peers. And the biggest mistake I see is when I ask even pre-revenue founders what the unit economics will be. About 30% of the time they say, I have no idea because I'm pre-revenue. And I say, listen, within this space, that's not really an excuse, because you can kind of back into it or look at enough public data to be able to understand, how your product might perform. Um, so that's kind of one of the aspects of it. I mean, the second is just thinking that their model will be better than the existing status quo. And that's not necessarily true when it comes to lending either. You may have a lower cost of acquisition because you're using an embedded model, but at least from the hundreds of lending deals that I've seen, you're probably not going to be any better off when it comes to default rates than, your lower tech brick and mortar peer. And if you kind of net all this out at the end of the day, the unit economics on a per loan basis are about the same. So that's kind of one example that I give to people, is that having naive optimism within lending and private credit focused startups can actually be a negative factor, because you have to remember you're stewards of debt capital, which is way different than venture capital, and it's a way different risk profile. And I look for founders that can have both the grand vision of scaling the company so the equity makes money, but also remembering that they're stewards of debt capital. And if they default on their facility by making bad loans or not having the ability to manage risk, that the company goes away because the creditors are the first one to seize, whatever is left as well. So I look for people that can have this kind of balanced sense of optimism and, founder drive with the institutional wherewithal to manage potentially hundreds of millions, if not billions, of institutional grade credit. And that's
Yeah.
actually much harder to find than one might think, because it takes two different hats. You kind of have to wear, one on one side and one on the other at almost all times.
Yeah, I mean, you're talking about a founder who has, if you will, the ability to, build and recruit a team, the technology, the vision to, enter new markets, or for example, go international, enter these strategic partnerships, but at the same time, like, has to have a credit hat and has to have the ability to understand risk and understand the macro environment, et cetera. And that is a rare combination. I would agree. I want to ask you, I spoke to a founder recently and kind of give you a setup. I won't name the name. They're going after the, let's call it the working capital market. That's a
Hmm.
gigantic market. Small businesses need working capital. Access to capital for small businesses is the lifeblood, right? Uh, and in this case, this is in the call it the trade business, the construction services businesses. And what was interesting about the conversation is they very, very early, right, they have customers. These are small businesses, and they have decided to partner with a lender. So like you said, that embedded lending kind of playbook, rather than building out their own internal models, their own underwriting processes, their own origination processes, if you will. They I would say they do have a little bit of the origination, but the underwriting and the loan tape and a lot of those things, they don't have because they're effectively renting the capital.
Yeah.
Um, when you see those types of models and they're going after a market where, okay, maybe the customer experience is not very good, the existing lender probably doesn't offer a dashboard to the small business with all kinds of bells and whistles. They probably don't have great customer service. They probably don't understand that particular industry very well, but they do have a balance sheet. And you see a couple of entrepreneurs that are going and attacking that in this way, like without a loan facility and without a balance sheet. Can that work? And I'm curious what kinds of things you look for in that case, where they're sort of originating, but they're using kind of third party embedded financing model to do so.
So to clarify, are they brokering the loans? Are they doing a forward flow, or how
It's not really
specifically? Not
forward
to get.
flow or yeah, it's not really forward flow or brokering. They have relationships with this particular industry, and so when folks come to their website and apply, they're effectively kicked over to a third party, system to fill out paperwork, apply for the capital, and then they get a credit decision from that partner within a day to 2 days. But the founder said, sometimes we get phone calls from the founder because they're saying, hey, I was supposed to get a decision in 24 hours. It's now been 3 days. And it turns out that it's just a wonkier underwrite. And sometimes they have to turn down the business, And so, yeah, it's not so much forward flow as it's like they've got an in to a specific industry and they're able to like kick over that credit file, if you will, to somebody else who's making the final credit decision.
So it's an interesting model, but the question would bear is whether it's more efficient than the status quo. And so we've
Right.
seen a lot of companies that are trying to become more efficient loan brokers in the small business space for loans under 250,000, where your stove breaks and you want to get your loan within 24 hours if you have a restaurant, or else you're out of business.
Right.
And there, what these providers are competing with is, shops of people that have a sales force and are just calling books of business and placing loans with the existing non-bank finance providers. And it's not terribly efficient. And we've seen some that have tried to standardize credit boxes and underwriting and document management, or even, you know, scraping bank statements with OCR. And the vast majority of these companies, at least that we've looked at, are no more efficient than the brokers themselves. And because they're investing so heavily in the tech, they're not as profitable either as the brokers themselves, which
Because they're not
is
capturing
quite
like
interesting.
interest margin, right? They're not they're getting like 1% origination maybe, but the economics might not be as attractive, is what you're saying, as the brick and mortar specialty financed business.
So I'm talking about the brokers that are brick and mortar brokers that have no balance sheet exposure, and
Got
comparing
it.
them to a
Yeah, yeah,
tech-enabled
yeah.
broker. I mean,
Got it.
obviously, it would be great to have the net interest margin, but what I'm saying is
Yeah,
that,
the broker. Yeah,
yeah, and they're no more efficient. There can be, depends on how you look at it, but 1 to 10% close rate of the loans that you get in as a broker, you know, typically it can be 1 to 5, still a very large range percent. And, you know, typically I've not seen any tech enabled provider that claims to save time and money be more efficient than that kind of status quo.
yeah,
And there, there's no real value in the software or the bells and whistles that a company has built. And obviously, not implying this company because I haven't met
sure,
them, but
sure.
just generally speaking, I haven't really seen many tools that have tried and successfully change this. And it's
Yeah,
it's also another area within kind of more middle market finance of loans, let's call them 1 million to 10 million, which has been one of the toughest markets to create from an efficiency standpoint. And we've seen a lot of providers try to match make community banks and expedite their underwriting process by giving them warm leads. And I haven't seen any sorts of real successes quite yet in that area either. And, in my view, it's still something that's done, via phone calls and via, hand-to-hand comment that is not going to be replaced by a chat bot or some sort of AI enabled tool or better document handling. You're still going to have to chase people in email for their, you know, prior 2 years tax returns, etc. Some sort of chat
yeah,
bot or upload here is not going to really move that forward. It might be easier to make the end process achievable, but you're still going to have to chase someone somehow. And these business owners are running around, so the only way to do it is a phone call or a text message. No one's going to do a little chat bot that you download.
yeah,
As
yeah.
well.
I had a founder of a, I wouldn't call him a broker. It's not how he characterizes services, but he's really helping connect. I thought he was helping small and medium sized businesses going after that. 1 to 10. His sweet spot's really 7 to 12 million, up to 25, but as small as 1 million. And I sort of preface the question of, you help them go find debt capital. And he said, well, it's really the reverse. Like, I help the debt capital kind of find sources of origination, if you will.
Yeah.
Like, he has 250 relationships with various finance companies, non-bank lenders, some private credit funds, some asset managers, but it's a lot of, like you say, these finance companies, right, that have capital. And you know having that sort of, use the old term network, Rolodex, whatever, is extremely valuable to these founders, right, who may have a CFO, but or a treasury department, but that person is not setting up transactions and closing deals and collecting term sheets for a living. So they're only going to see so much, so much deal flow. I want to ask you about the embedded nature of financing. It seems like every SaaS company is trying to verticalize and create an embedded finance value proposition, almost like, do that, put AI on the end, and go to market. I'm saying that tongue in cheek, but what, from your perspective, I mean, you see hundreds and hundreds of transactions and deals, you get that pattern recognition. Um, what do you make of, the verticalization of the SaaS model and the embedded finance? Does it really come back down to, as a well-known credit executive says, two things: assets and cash flows?
I mean, it should. And I mean, not to pick on some of the larger companies, but a lot of them have created embedded finance options that have not gone terribly well, and now they're kind of walking back these programs and exiting them completely because they saw them as a way to make ancillary revenues. most notably Amazon announcing the other day that they're getting out of the space for financing their, businesses on the platform that resell with them. And, you look at a few others and they're also kind of exiting the space. So
I didn't
in
know that,
my
by the
view,
way. That's interesting. Yeah, that's
yeah,
interesting. They
I'll send
announced
the
they're coming back.
article
Okay.
and you can link
Yeah.
it. But they're getting out of this space, and they would be the most logical provider. Shopify has another big business, which I think is going better, but a lot of these providers are providing the working capital finance because they do have the data on the other end.
Sure. Yeah.
So it's possible, but the what's happening now is a lot of them are kind of walking back and not really getting as involved as they were in these areas. And when it comes to embedded finance more specifically, I think it's gotten to be quite crowded of a space. And, I think we're going to see somewhat of a shakeout when it comes to the players, because there's just a lot of money poured in during zero interest rates, and now it's gotten incredibly more difficult to make money in the specific area. So I think time will tell, but I definitely am treading with caution when I'm looking at new embedded finance providers.
Yeah.
And, it should be interesting to see. I think on the flip side, the area that I like is, and it's gotten big enough because there are embedded finance players buying or borrowing money from large credit funds, is the infrastructure space to help these embedded finance providers manage their institutional credit facilities, from covenants to borrowing based calculations. There's a lot of software there, and I think that is a pretty interesting
Yeah.
area of technology and lending that we're looking at pretty heavily.
Yeah, yeah. I had a guy, Mike Schum, on from Cascade. I'll put the
Yeah.
link to that recording, and they came out of kind of this whole ecosystem. They were actually doing, I'm gonna call it microfinance, but they were doing finance like in emerging markets, and really saw just a lack of standardization and software for the debt markets that existed on the equity markets. And so so they're building a company, like I said, Cascade, which provides a lot of this debt management software. And as debt proliferates, private credit grows, I think there's a value proposition both for the originator, who has multiple credit facilities and multiple different financing arrangements, or could, and also for, even theoretically, like the asset management side of the business that has lots of underlying exposures, lots of underlying loans, and has obligations to its LPs, and needs to kind of have a better understanding about what they own and be able to do the same type of attribution that you would sort of ask for from an equity shop or a hedge fund back in the day. So I think that you're right. Like, that's an interesting area. I want to ask you about capital when it comes to private credit. There's been so much money raised in private credit over the last 5 years. And, we saw and heard this, dry powder argument. It still may exist with private equity and maybe to some extent venture. All this capital in private credit. I was just up in New York a few weeks ago, and all these big, gigantic, publicly traded asset managers, and more of them coming. I think we saw CVC went public this week. They all are adding, with the exception of a couple, like more businesses. Their platforms are getting bigger. It seems like they're gobbling up majority of the capital, and it's increasingly coming from private wealth and retail. But income and credit and yield, those are like super hot areas, and I don't see that train slowing down. It may change a little bit when rates go, from 7-8% on an auto loan or a mortgage, down over the next few years, but we're not going back to 1 or 0. I think everybody agrees. So my question is, with all that credit that's there, and all the capital that needs to be put to work, and will need to find a place. Is the market, in terms of what you guys are looking at Fintech Ventures, is it as exciting as it's ever been, or is it require an even bigger set of binoculars to find these, founders and find these businesses, to I'm gonna say match up, but to help realize the capital opportunity that is out there?
So I'd say it's maybe shifting your binoculars, to use that analogy, in
Okay.
a different direction. Whereas, you're looking at traditional originators that we started looking at 2016 to 19. There are still ones that are out there that will get funded. Then you have kind of the proliferation of embedded finance as well,
Yep.
which is just a real change to the front end in terms of how you distribute these loans. That, I would say, is here to stay as well. But with these kind of waves 1 and 2 of the fintech alternative lending 1.0, and then embedded being 2.0, for lack of better numbers,
Yeah. Yeah.
3.0, in my view, and we're already seeing this, is the technology to serve as the infrastructure behind the scenes for the
Okay.
space. And whether that's plug and play embedded finance drop ins for people building applications where they want to offer the financing directly, we're seeing some of those, or whether it's some of the platforms, including the one you mentioned, that are helping people manage their institutional grade credit facilities. I
Sure.
think those areas are all going to change and continue to grow much larger. And
Yeah.
clearly, everyone's thinking about how can AI jump in here, but in my view, I don't see that occurring, at least from the underwriting side, but maybe from the servicing side. But we're still kind of a long ways off, and I'm not sitting there looking for the next AI based consumer lending servicing startup yet.
Yeah. 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 Okay, last couple of questions. You spend a lot of time on the road. You interact with lots of VCs, lots of founders, lots of folks in the debt markets, and just other practitioners who are helping the startup ecosystem and founders in various functions, fractionally or on a consultative basis. Um, Given the environment we're in, the higher rate environment, and it just appears that we continue to get data from the Fed that inflation it's kind of sticky, right? We saw numbers last week. We're sitting here at April 30 today. We saw numbers come out last week that just continues to be sticky. There's really no other way to put it. On the other hand, you can look at lots of other data, wages, unemployment, um, earnings, and be quite, you know, optimistic, I guess. But it just feels like there's a lot of uncertainty, and it feels like there's a lot of discomfort. Um, the setup there being, when you're traveling, talking, and attending all these events and conferences, are people real bullish, or are they bearish, or are they somewhere in the middle when it comes to fintech and kind of these new models that you just described, maybe asset light, but infrastructure building, good old fashioned lending, but maybe a different lens, different approach? What are you hearing in the, at the coffee bar, and in the hallways, talking amongst these folks, when it comes to these new fintech models?
So it's been interesting. I mean, if you want to dial into the conferences, there was a prominent fintech conference that has started off with only being focused on lending, Lend It, which is a great conference. And then about 2, 3 years ago, the viewpoint was there was not enough demand to do a conference specifically focused around technology enabled lending specifically. So they rebranded to Nexus and offered different chains of or different tracks, I should say.
Yeah.
And as of the last year, I believe the conference is no longer in business. And, in my view, that is somewhat of an analogy for the space, meaning that, there's not enough demand around the conference, but, there's still enough there. So I would say it's the sign of maturity from an industry that really only started at the end of the financial crisis, has hit somewhat of a critical mass. But right now, we're in an interesting period that we've never experienced, which is rates, at the highest level since the start of technology enabled lending.
Yeah.
And you're definitely seeing a shakeout when it comes to certain originators. Revenue-based finance for technology companies is under an incredible amount of pressure, for instance. And I think we're kind of in the middle innings of a considerable shakeout within the space. And this
Yeah.
kind of occurred, to go back in history, around 2017 and 2018. We kind of saw a consolidation with a lot of consumer lending platforms that came up during the lending club and prosper teenage years in terms of their life cycles go out of business. And then you actually saw a whole wave of companies after COVID, especially on the embedded finance side, start to crop up. And now I think we're going to see just an eventual maturity of a lot of the sector occur, because of the fact that, you know, it's hard to exit these businesses, and the impact of rates is starting to trickle
Yeah.
down a lot of
I
these
think there's a
businesses.
reality, right? There's a
Yeah.
reality that's set in. I mean, I think, not to take shots at any particular practitioners, it's just generally the case that there was a lot more venture that went into fintech in 18, 19, 20, 21, and it was the guys Aries, the in the gaps pieces that they put out, or their quarterly commentaries. I mean, that's like required listening in my estimation, just because they're so astute and they get it, and they understand all these underlying markets. And I think in their Q4, or maybe it was Q1 probably, piece, they talked about, a lot of the VC market, funded a lot of these businesses as software businesses, put a good multiple on them, and now they're looking at him and saying these are actually lending businesses, and that's just a totally different business, right? And I'll be interesting to see how many of them, get follow-on financing, or how many of them get follow-on equity, when those businesses need to raise equity. Maybe they are raising equity. I got to think that there's, like you said, there's a reckoning. Last question I want to ask you, and we'll have to do a 2.0 because there's so much that we didn't get to today on this first one. But I'd love to have you back on Asset Back to talk about more in the weeds. But I'd love to ask you, Luke, about you know founders who are preparing to, whether it's go in front of VCs that are very fintech focused, and that are either software plays, and or these infrastructure plays, or they have a more traditional lending business, and their take on it is that they think they can do it, potentially cheaper, or they can service better, still a loan. But let's just say they've got some initial traction, and they've made some loans, or building a tape, and they are starting to go out to do that, maybe that seed, or potentially like that pre-series A bridge round. What are you wanting them to really step back and think about? You mentioned not being so much head down that you don't understand unit economics and don't understand, some of the things you guys are contending with. But what would be your message to founders? That'd be my last question for you today on kind of 1.0 here.
Yeah, no, definitely. I mean, this was great, and thanks for having me, and definitely interested in 2.0. I wanted to quickly go back to something you mentioned in your last point regarding these companies being valued as software companies, and something we're exploring,
Yeah.
which I will articulate more as it comes out, is looking at a different security on the equity side completely to invest in these companies, whether
Okay.
it's similar to something like a redeemable preferred that banks have been using, or something that works better for lending companies that are not going to be venture type SaaS outcomes. And if they are, they're going to perform poorly in public markets. And virtually all of the companies that we've seen that have gone public at massive valuations have done so. So that's kind of something that maybe we talk about in 2.0
Yeah.
and go further into the weeds, because obviously we both enjoy this. But when it comes to founders and loan tapes, I'd say the the interesting part about where technology is currently for alternative lending is that it is relatively easy to get started originating loans. You can take an off the shelf loan origination system that won't cost you an arm and a leg. And then, assuming you have the capital as collateral, you can go out and plug in. It will be a high cost provider that basically can offer you lending as a service, so you can start originating loans from day one. So, in
Right. I
my
mean, that's the
view,
startup. That's
yeah,
the startup. That's the startup I just described effectively, right? So now you're in
yeah,
business. You go
yeah,
after your niche. You start getting some customers.
yeah.
Yeah.
But, there it's, at least for a venture model, unfortunately, that's not good enough. You kind of have to think about your unique approach to your product and be able to articulate that and start building that even as you're originating loans. And so that's why I tell people that get started, show that you have a loan tape, because you need to generate that to get institutional credit to help scale. But also think about, why your business model is unique, and what sorts of nuances you have. Like I said, in my view, it's mainly customer acquisition is really the only place you can innovate, because other products are too hard to understand or may not even be feasible under the current or any regulations. And trying to go and understand your unique insight to acquiring customers is probably your best bet when it comes to starting a lending company now. And this is
Yeah.
why embedded finance providers have taken off, is because they are significantly reducing the CAC and friction of acquiring someone that wants to borrow money. Because, thinking that you're going to reduce defaults by 50% using machine learning and AI, I would be very surprised to see anyone that can do that at scale. And so, in my view, it's focusing on customer experience and better mousetraps for acquisition. That's really the areas that I see direct originators still being able to innovate in. But, again, I would sit here and try to throw out ideas of where to look, and just currently I don't have many, because a lot of it has been tried, and now it's about thinking about different ways of doing business, or going, like I said, to smaller niche markets that are still large enough to build good businesses in, but may be overlooked because they're not exciting enough or not attractive enough to entrepreneurs. And so, inventory finance for used auto dealers, have another player in the debt collection space and is looking at financing around that. Another 10 to $15 billion industry, looking at specific industries and doubling down would be my advice to start a lending company, as opposed to just looking at consumer prime lending for every single consumer with an auto or something like
Yeah.
that.
It sounds like that we'll just do a preview while we're here, because
Sure.
it's a good opportunity for us to talk about the next show that
Yeah.
Luke and I are going to do. Is we're going to dive into the 2.0, and I think some areas that you hit on today would be great setup. I'd love to have you back on. One is unique origination, and what does that truly look like? And when a startup that is looking for financing, whether it's equity or debt, is talking about our unique ability to originate, our differentiation, how we're going to acquire customers, whatever you want to call it, what does that really mean? So I think that's one good topic. I think a second one is uh, customer experience. You know, you can go throw a whole bunch of venture money at bringing on a whole bunch of people to sit in a call center or whatever model. Maybe they're going to sit at home. They're going to do both. But you know, we've also seen the cost of doing that. You brought this up earlier. May not be any cheaper than the cost of doing that without a tech aspect to it, right? So
Yeah.
let's talk about that as a second topic. Like, how do you do customer experience cheaper but better? I think that would be interesting. And then I think a third area, which you just hit on, which are these niches. As somebody coined the term, you know, and I'll just use it: the riches are in the niches of credit, right?
Yeah.
So there's all these specialized areas of credit. You know, I think PIMCO said that specialty finance is a, you know, it's in the trillions in terms of what it is. It's more than just consumer loans, it's mortgages, it's auto, it's all these other areas, you know, buying a refrigerator, you know, buying appliances, and more and more and more. And so these are gigantic markets. They used to largely get financed and from a takeout standpoint in the public ABS. Now we're seeing more private ABS. That market's in its infancy. So maybe a third area we could dive into is just these more esoteric, nuanced areas of credit that potentially are, you know, maybe not ripe for innovation, but because they are there, but you know, they are open for business, let's say, from the standpoint of tech companies when it comes to what we just talked about, you know, a unique insight on origination, a unique way to service the customer and deliver a better experience. Anything else in
Yeah, I
our
mean,
preview?
closing point before part two would be that you know, we say it's unique, but it's not really that unique. It might just be selling something else completely or packaging a loan, obviously, if it's regulatorily compliant to do so in a different manner. And so, an
Yeah.
example I'll give of an interesting model of a company that we have is they're selling an owner benefit package to single family landlords sold through the property managers of said properties,
Hmm.
and that includes insurance against tenant default. And that's a very high a high friction product to sell on your own. But they're also layering in a lending component to get up to a year's worth of rent, essentially default free from the property. But it is all sold via a SaaS subscription model that the property manager takes out to all of his property owners and does on an opt-out basis. So you basically are paying
Hmm.
a monthly SaaS fee to get the rights to your future cash flows through this owner benefit package, and it's worked out incredibly well. And so in my view,
Interesting. Yeah.
you know,
Yeah. So a
forceful,
gigantic asset
yeah,
class. Yeah.
yeah. Or getting
Multifamily.
people to
Big
pay for
gigantic.
the
Yeah.
rights to their own lending is actually to borrow. Getting people to pay for the right to borrow is actually an incredibly efficient manner of customer acquisition that a lot of people overlook because it sounds counterintuitive. But I'll leave it
Yeah.
there.
Yeah. Well, that's 4 areas, folks, that are tuning in to the Asset Back podcast that you can expect Luke Timberlake, general partner from Fintech Ventures, um, and I to break down on a future show. We might have to turn this into a recurring series, but um, we will leave it there. We have many things to talk about when it comes to specialized finance, specialty finance, private credit, fintech lending. But this was a great start. I think we can offer the audience quite a bit, whether it's a founder or it's a lender or it's other folks that are in this ecosystem. So I look forward to having you back on a future show.
Likewise, I appreciate it and talk to you soon.
Luke Timberlake, general partner with Fintech Ventures, focused in the fintech area, specialized lending, fintech lending, offices in New York as well as Atlanta. Thank you for joining me today on the Asset Back Podcast.
Thanks for having me.